Hey folks, Rick Sullivan here, welcoming you to the NASDUCK Weekly Podcast. Today, we're talking Apple and what they've got in store for us this coming week. Apple's Big Dog and Pony Show is coming up Tuesday, September 9th. They're calling it the Awe-Dropping event. And if you've been following my newsletter, you know I'm mostly interested in what those big events mean for your portfolio, not merely what tech bloggers are gushing about. You see, this is a machine designed to separate you from your wealth. Apple has become the perfect example of how this rigged game works. Apple's holding their annual iPhone circus at 10 a.m. Pacific, 1 p.m. Eastern. It'll be streamed everywhere. Their website, YouTube, Apple TV. Tim Cook and his team are going to parade out in front of their fancy Cupertino campus and tell you about how revolutionary their latest rectangle with rounded corners is going to be. What we know for certain is actually confirmed. Apple sent out invites. The event is happening. They're going to show off the iPhone 17 lineup. Everything else floating around the tech press? Rumors, educated guesses, sometimes flat-out wishful thinking designed to generate clicks. The big story everyone's talking about is this ultra-thin iPhone they're calling the Air. If this thing actually exists, and multiple sources say it does, it will be around 5.5 to 6 millimeters thick. For context, that's about as thin as two credit cards stacked together. This matters because design resets drive upgrade cycles. Upgrade cycles drive revenue. Revenue drives stock prices. It's that simple. Most people don't upgrade their phones because the processor got 10% faster or the camera has 12 more megapixels. They upgrade when they hold a phone, and it feels fundamentally different. The original iPhone was a design reset. The iPhone X with Face ID was a design reset. This Air thing could be the first real design reset we've had in years. A super thin phone comes with trade-offs. Wall Street often overlooks this. You can't defy physics. Thinner means smaller battery. Thinner means compromises on the camera system. The rumors suggest this Air model might have only one camera lens, unlike the multiple lenses on the Pro models. The average consumer likely doesn't care. Most people use their phone camera to take pictures of their lunch and their kids. This tells you something about Apple's priorities right now. They're chasing design, prioritizing it over functionality. They're pursuing headlines, not substance. So what does it mean for Apple stock? Right now, Apple shares are trading around $240. Wall Street analysts have a consensus price target of about $238, with a range from $160 to $300. That's basically saying the stock is fairly valued, potentially slightly overvalued. However, those analysts aren't telling you about Apple events. They're typically sell the news moments. The stock often dips after the event, then recovers 30 to 60 days later. This is because the event is theater. It's spectacle. The real money comes from the data that follows: pre-order numbers, shipping times, early sales figures. Bank of America's Wamsi Mohan explicitly warned about a sell-the-news reaction this year unless Apple delivers surprises on AI or pricing. Surprises are key. The market has already priced in incremental improvements. It's priced in a thin phone. It's priced in camera upgrades. Apple delivering on artificial intelligence in a meaningful way is what the market hasn't priced in. This is where things get interesting, and where Apple might be in trouble. Apple is behind on AI, way behind. They delayed their major Siri upgrade, the one that was supposed to compete with ChatGPT and Google's Gemini, until 2026. Google has integrated AI into search, email, documents, everything. Microsoft has Copilot in Office. Meta has AI-powered advertising and content recommendation. Amazon has Alexa and AWS AI services. Apple has Siri, which still can't understand half of what you say to it. The delay of Apple's AI features until 2026 is a strategic failure, not just a minor setback. In technology, being 2 years behind is like being a decade behind. Sure, Apple talks about privacy and on-device processing, but consumers care about functionality more than privacy. Right now, Apple's AI is simply less functional than the competition. Consider that for a second. The company that wants to charge you $1,200 for a phone can't figure out how to make their digital assistant as smart as a free app you can download right now, indicating a strategic failure rather than a mere technical problem. Guess how much Apple lost in market value during their developer conference in June when they admitted this AI delay? $75 billion. That's more than the GDP of most countries, erased in a single day because investors realized Apple might not be the innovation powerhouse they thought they were. But the stock recovered because the machine needs Apple to work. The index funds need Apple to work. The pension funds need Apple to work. So they pretend everything's fine and hope nobody notices that the emperor has no clothes. If you're considering buying Apple stock around this event, don't chase the headlines. Don't buy on the day of the event. Don't get caught up in the hype. Smart money waits. They watch. They let the excitement fade and the reality set in. If you want to build a position in Apple, and this isn't investment advice, scale in over time. Buy a small position now if you must, but keep cash for after the event. If history repeats, you'll get a better price in the weeks that follow. Most analysts rate Apple as a buy with price targets around $238. But these analysts are often wined and dined by Apple's investor relations team. They have every incentive to be optimistic. If Apple doesn't make anything, they design stuff, they market stuff, but they don't manufacture anything. Everything gets made by suppliers, mostly in Asia. The iPhone 17 rumors suggest Apple is moving more components in-house. They already shipped their first in-house 5G modem in the iPhone 16e earlier this year. The rumors say they might be putting their own Wi-Fi chips in the iPhone 17 lineup. This matters because every chip Apple designs in-house is a chip they don't buy from someone else. That hurts suppliers like Qualcomm and Broadcom. It's also a margin story for Apple. They can potentially make these components cheaper than they can buy them. These supply chain changes are happening against the backdrop of increased tariffs and trade tensions. Apple's trying to reduce their dependence on Chinese manufacturing, but that's easier said than done when you're building hundreds of millions of devices. The reports suggest the iPhone 17 lineup might get a RAM bump, 12 gigabytes on the premium models, 8 gigabytes on the base model. That's good news for memory suppliers like Micron, Samsung, and SK Hynix. The US just revoked waivers that allowed Samsung and SK Hynix to upgrade their China operations, making geopolitics interesting. That doesn't hurt their current production, but it complicates future expansions. This over time could tilt more business toward Micron, which is the only major US memory manufacturer. If you're looking for a play on Apple's success that doesn't involve buying Apple directly, Micron might be worth considering. However, semiconductor stocks are volatile. They're cyclical. They can drop 50% when the cycle turns. Size your positions accordingly. China is the elephant in the room. Apple faces ongoing challenges from Trump's tariffs. However, this is just the tip of the iceberg. Chinese competitors like Huawei are throwing down the gauntlet in smartphones. Chinese consumers don't have the same brand loyalty to Apple that American consumers do. If Huawei or Xiaomi comes out with a phone that's 90% as good as an iPhone for half the price, Chinese consumers will buy it. This matters because China is the market for Apple, not merely a market. It's their second largest revenue source after the United States. Any weakness in China shows up directly in Apple's bottom line. So yes, China likely presents the biggest risk to Apple's business. Chinese companies like Huawei are getting more competitive. Unlike in the US, where Apple has built up decades of brand loyalty, Chinese consumers are more pragmatic. They'll switch to a domestic brand if it offers better value, plus there's the geopolitical angle. If US-China tensions escalate, and they probably will, Apple could find itself caught in the middle. Chinese consumers might boycott American brands. The Chinese government might make it harder for Apple to do business there. Apple's revenue from Greater China was $15 billion last quarter. That's about 16% of total revenue. If that disappears or even declines significantly, it's going to hurt. Let's move on to something different. The Apple ecosystem is a perfect example of how modern capitalism has become extractive, not innovative. Think about it. Apple takes components made by suppliers, assembles them in factories they don't own using labor they don't directly employ, then sells the finished product for a 40% gross margin. They've created this walled garden where once you're in, you're trapped. Your photos are in iCloud, your music is in Apple Music, your apps only work on iOS. That stickiness is incredibly valuable. It means Apple doesn't have to win you over every time you upgrade. They just have to not screw up badly enough to make you want to leave. For most people, that's a low bar to clear. Switching from iPhone to Android means losing your message history, rebuying apps, learning a new interface. Most people won't do it unless Apple really disappoints them. It's brilliant in a sociopathic kind of way. They've figured out how to extract maximum value while taking minimum risk. The suppliers take the risk of building factories. The contract manufacturers take the risk of hiring workers. Apple just takes the profits. We celebrate this. We call Tim Cook a visionary. We worship at the altar of shareholder value creation. Meanwhile, the people actually making these devices, the workers in the factories, they can't afford to buy the products they're building. This is what late-stage capitalism looks like. A few companies extracting enormous wealth while everyone else fights over the scraps. So I think we can agree Apple's business model is fundamentally dependent on inequality. They need customers rich enough to pay premium prices for gadgets and workers poor enough to assemble those gadgets for almost nothing. Apple reported that supply chain pressures and tariffs will have a $1.1 billion impact on operating margins. Paying fair wages to the people who actually make their products would have an even bigger impact. This is the dirty secret of globalization. It's about exploitation, not efficiency. Moving manufacturing to countries with lower wages, weaker labor protections, and fewer environmental regulations. Then selling the finished products in wealthy countries for massive markups. It doesn't have to be this way. We could have a system where the people who create value actually get to share in that value. We could have a system where companies compete on innovation rather than on who can exploit workers most effectively. That would require changing the rules of the game. The people who benefit from the current rules, people like Apple's shareholders, don't want those rules to change. Understand your investment in Apple. You're investing in a machine designed to extract wealth from consumers and concentrate it in the hands of shareholders, not in innovation or making the world a better place. If that's the game we're playing, and it is, then you might as well be on the winning side. Do it smart. Don't get emotional about Apple. Don't fall in love with the brand. Treat it like what it is, a way to potentially make money. Here's my framework. If you want exposure to Apple, start small. Maybe 2 to 3% of your portfolio. Wait for weakness after the event. There usually is some. Add to your position if the fundamentals support it. Things like China sales holding up, margins staying healthy, that kind of thing. Don't put your life savings into Apple stock just because you like your iPhone. I've seen too many people get wiped out that way. If your analysts often point to Apple's services business, the App Store, iCloud, Apple Music, and similar offerings. Services revenue grew 13.3% in the last quarter, and it's higher margin than hardware. That services revenue is mostly App Store commissions and Google paying Apple to be the default search engine on iOS. The App Store commissions come from the same ecosystem lock-in I mentioned earlier. Developers pay Apple 30% because they have to, not because they want to. It's a tax on accessing iOS users. The Google payments, those are basically Google paying Apple to not compete with them in search. It's $20 billion a year in what amounts to protection money. Neither of those revenue streams requires innovation. They just do require maintaining the status quo. That's fine for a utility company, but it's not what you'd expect from a technology leader. The services business is only as strong as the hardware business. If iPhone sales decline, App Store revenue declines. If people stop buying Macs, they stop subscribing to iCloud. It's all connected. If iPhone market share drops from 50% to 40% in the US, services revenue will be impacted. This is the real risk here. Do not play Apple earnings with options unless you truly know what you're doing. And I'm not talking I watched a YouTube video kind of knowledge. Event weeks pump up implied volatility. After the event, that volatility collapses. Your calls can lose money even if the stock goes up. Your puts can lose money even if the stock goes down. It's a complicated game designed by professionals to take money from amateurs. If you insist on using options, and I'm not recommending it, keep it simple. Covered calls on shares you already own. Put spreads as limited hedges. No weekly lottery tickets. If your Apple's event is happening in a weird market environment, Apple stock is down 4.7% this year while Microsoft and Alphabet have surged on AI hype. That tells you something about investor sentiment right now. The market is rewarding companies that are winning the AI race and punishing companies that are behind. Apple falls into the latter category right now, despite what their marketing department wants you to believe. But Apple did just report record revenue of $94 billion in Q3. The underlying business is still strong. iPhone sales were up 13.5%. The question is whether that can continue in a more competitive environment. What I'm watching for on Tuesday's event? First, any concrete details about AI and Siri improvements. Not demos, not promises, actual features with actual availability dates. Second, pricing. If Apple raises prices without adding meaningful value, that's a red flag. It means they're pushing the envelope on what consumers will pay. Then, any commentary about China or international markets. Tim Cook's usually pretty diplomatic, but if there's weakness there, you'll hear it in the careful language they use. And finally, anything about supply chain or manufacturing. With all the geopolitical tensions, any hint of disruption could move the stock. The bottom line on Apple as an investment, it's still a cash-generating machine. It still has incredible brand loyalty in key markets. It still has that ecosystem lock-in that makes it painful for customers to switch, but it's not the growth story it used to be. The iPhone business is mature. The days of 20% annual growth are over. This is now a slow-growth, dividend-paying, share buyback machine. That's fine if you understand what you're buying, but don't expect miracles. Don't expect the next iPhone to change the world. Those days are gone. If most Wall Street analysts have price targets with a range from $180 to $280, this wide range indicates uncertainty about the stock's true worth. The bulls point to the services business, the ecosystem, the brand strength. The bears point to slowing growth, increased competition, and the AI lag. They're both right. The truth is, Apple is neither a screaming buy nor a screaming sell. It's just there, a large, profitable, somewhat boring technology company that occasionally pretends it's still innovative. So now, what to consider if you're an investor? Watch the event for entertainment value, but don't make any investment decisions based on the presentation. Wait for the reality check that comes afterward. Dollar cost average into Apple stock over time if you want to own it. Buy a little now, buy a little more if it drops after the event. Reassess in a month based on actual sales data. Don't get cute with options or leverage. This isn't a momentum play. It's a slow burn, dividend-paying, mature technology company that happens to make phones. Keep your position size reasonable. Apple's 7% of the S&P 500, but that doesn't mean it should be 7% of your portfolio. Maybe 3 to 5% max, depending on your risk tolerance. Consider the supplier ecosystem for a different approach. Companies like Micron could benefit from increased memory requirements. But remember, these are higher risk, higher volatility plays. The display suppliers, Samsung, LG Display, will get some benefit if iPhone volumes increase. But the margins there are terrible. These companies are in a constant race to the bottom on pricing. The camera suppliers, Sony, LG, Innotek, similar story. They might see some volume increase, but Apple squeezes their suppliers on price relentlessly. Avoid satellite plays, Globalstar, and similar are pure speculation. Lottery ticket sizing only, if at all. Folks, we've got persistent inflation despite what the government statistics say. We've got geopolitical tensions and a banking system that's still fragile from the regional bank failures earlier this year. In that environment, Apple's cash hoard actually becomes an asset. They've got over $60 billion in net cash. That's a war chest that can fund acquisitions, weather downturns, and return cash to shareholders through dividends and buybacks. but it's also a sign that they don't have enough profitable growth opportunities to invest in. If they did, they'd be spending that cash on R&D and expansion, not stockpiling it. The question that needs considering is whether Apple remains a technology company, or has it perhaps evolved into a luxury goods company that merely utilizes technology? That's not necessarily a bad business model. Louis Vuitton makes handbags that aren't functionally better than bags that cost 1/10 as much, but people pay for the brand and the status signaling. The problem is that luxury goods companies don't get technology company valuations, nor do they get the growth multiples or the same investor enthusiasm. If the market starts viewing Apple as a luxury goods company rather than a technology company, that multiple compression could be painful for shareholders. A prediction: the stock will likely trade higher going into the event as excitement builds. Then it either drifts lower or stays flat afterward as reality sets in. Then, over the following weeks, it moves based on actual sales data and analyst commentary. The key variables will be: does the thin design actually drive upgrades? Do the new features justify the likely price increases? How does the China situation develop? If Apple can show that people are willing to pay more for a thinner phone, that's good for margins and the stock. If the launch falls flat and they have to cut prices or increase promotions, that's bad. Bull case: Apple's ecosystem continues to strengthen. Services revenue keeps growing. The thin iPhone drives a new upgrade cycle. They eventually figure out AI. The cash hoard provides flexibility. Brand loyalty remains strong in key markets. Now for the bear case: competition intensifies, especially in China. The AI gap widens. Upgrade cycles continue to lengthen as phones get good enough. Regulatory pressure increases on App Store fees. The ecosystem advantage erodes as cross-platform apps improve. Both scenarios are plausible. That's why the stock trades where it does. The market is pricing in a probability-weighted average of these outcomes. Investors who have engaged this far likely think independently. They don't just follow the crowd, they ask hard questions. Good, keep doing that. Apple is a fine company. It might even be a fine investment. But don't get caught up in the hype. Don't mistake marketing for innovation. Don't confuse brand loyalty with competitive advantage. Treat Apple like what it is: a large, profitable, mature company that's very good at what it does, but isn't going to dramatically change the world anymore. Zooming out one more time, everything we've been talking about: Apple's stock price, supplier relationships, ecosystem lock-in, Chinese manufacturing, it's all part of a global economic system that concentrates wealth and power in the hands of a few large corporations and their shareholders. That system has created enormous wealth for people like us, people with money to invest, but it's also created enormous inequality, environmental destruction, and social instability. I'm not saying don't participate in the system, I'm saying understand what you're participating in. And if you find some time, think about how we might build something better. To conclude today's discussion, Apple's event is Tuesday, September 9th, 10 a.m. Pacific. Watch it if you want, skip it if you don't. The real information will come from sales data in the weeks that follow. If you're invested in Apple, don't panic, don't get overexcited. If you're thinking about investing, be patient. Wait for the post-event reality check. In the long run, the fundamental question remains: how do we build wealth in a system designed to extract it from us? That's the real challenge. That's what NASDUCK is all about. Understanding the game well enough to, maybe, someday, change the rules is the goal, not merely making money. Thanks for listening. I'll be back next week with more insights from behind enemy lines. Until then, keep your powder dry and your eyes open. This is Rick Sullivan signing off. Stay smart out there.